two friends, an identical $50,000, and two wildly different futures. 20 years ago, Jake and Sim stood at a classic financial crossroads. One of them was about to buy himself a second job, and he wouldn't even realize it for years. The other was about to watch numbers on a screen, quietly missing out on what some call the most powerful wealth-building tool there is. Both were absolutely convinced they were making the smarter choice. By the end of this, you won't just see who won their 20-year battle for $500,000. You'll know exactly which one of them you actually want to be. All right, let's rewind the clock 20 years. Meet Jake and Sim. They're in their late 20s, making the same money, and after years of serious saving, they've each scraped together a $50,000 nest egg. The only thing that's different, what they do next. Jake goes the route your parents probably preached. He's buying something real, something you can stand on and point to. He's buying a rental property. Sim goes the route the finance gurus on the internet won't shut up about. He's taken that same $50,000 and sinking it into the stock market with a simple index fund. They shake hands, wish each other luck, and just like that, the race is on. Each one is positive he's outsmarted the other. Let's see how that worked out for them. Jake immediately gets to work. He finds a solid 3-bedroom, 2-bath house for $250,000. His $50,000 is the perfect 20% down payment, letting him dodge extra insurance costs. The bank covers the other $200,000. With a 30-year fixed mortgage rate around 6.5%, a reasonable rate for back then, his monthly principal and interest payment lands around $1,260. After a few weeks of cleaning and listing, he finds a great family to move in for $1,800 a month. On paper, the math feels like a lottery win. $1,800 in rent, minus his $1,260 mortgage payment, that's over $500 a month. Jake feels like a genius. He drives past his house on the way to work. At parties, people ask for updates on his property. He has a story. Meanwhile, what's Sim up to? He takes his $50,000, opens a brokerage account, and puts it all in a total stock market index fund. Think of it as buying a tiny sliver of the entire U.S. economy. Instead of betting on one horse, he's betting on the whole race. He also sets up an automatic $300 transfer from his paycheck into that fund every single month. And then, crickets. His friends ask, "What are you investing in?" He says, "Index funds." They nod and change the subject. There's no house to drive by, no tenants to screen, no story to tell. Year one for Jake is all action and excitement. For Sim, it's all discipline and silence. Fast forward 3 years, Jake has collected a cool $64,800 in rent. Sounds amazing, right? But here comes the reality check every landlord gets. Where did that money really go? First, there's the mortgage itself. He's paid about $45,360 to the bank. Then, property taxes. Let's call it $3,000 a year, so that's $9,000 gone. Homeowner's insurance, about $1,200 a year, so another $3,600 vanished. But wait, there's more. In year 2, the water heater gave up, a $1,500 emergency replacement. 6 months ago, a storm ripped off some shingles, another $2,000 repair. And between his first and second tenant, the house sat empty for a month. That's $1,800 in lost rent, plus $500 for fresh paint and cleaning. When Jake actually does the math, his profit after 3 years isn't some huge number. After all those hidden costs and mortgage payments, his actual cash in pocket is closer to $1,000. It's not a loss, but it's a far cry from the easy money he dreamed of. And that doesn't even count the time spent on phone calls with plumbers and showing the property on weekends. And Sim? He's done nothing, not a single emergency call. He just kept his automatic $300 monthly investment going. The stock market had its ups and downs, but his initial $50,000 plus the $10,800 he's added has been quietly growing. Historically, the S&P 500 has averaged around a 10% annual return over the long run. His portfolio is now sitting at about $78,000, and he spent 0 hours managing it. Now we jump a decade into the game. This is where Jake's strategy flexes its biggest muscle: leverage. Jake's $250,000 house, with a conservative 4% average appreciation, is now worth about $370,000. The mortgage he's been paying down monthly is now around $177,000. This means his equity, the part he actually owns, has exploded to over $193,000. He started with $50,000 of his own money and turned it into nearly $200,000 in equity. How? He controlled a $250,000 asset from day one with the bank's money. That's leverage. Let's do a side-by-side at the 10-year mark. Jake, real estate. Property value, $370,000. Mortgage owed, $177,000. Total equity, $193,000. Cumulative cash flow estimate, maybe $15,000. Time and stress, hundreds of hours, lots of headaches. Secret weapon, tax deductions for things like depreciation and mortgage interest, which lowered his taxable income every year. Sim, stock market. Total invested, $50,000 plus $36,000 monthly contributions equals $86,000. Portfolio value, around $175,000. Time and stress, maybe 10 hours total. Near zero stress. Secret weapon, simplicity and zero debt. On paper, Jake is clearly ahead by about $33,000 in net worth. He's winning, but he's also carrying a massive six-figure debt and has all his eggs in one single, hard-to-sell basket. Sim is a little behind, but he's debt-free, and his wealth grew while he was sleeping. So Jake's leverage seems to be paying off, but the next 10 years can change everything. If you're finding this breakdown useful and you're starting to wonder if you're a Jake or a Sim, do me a favor and hit that like button. It tells the algorithm you want more real-world financial showdowns like this one. Now, let's get to the grand finale. 20 years. It's time to see where they landed. Let's start with Jake. His property kept appreciating. That $250,000 house is now worth around $550,000. After 2 decades of payments, he's paid down a huge chunk of his mortgage and now only owes about $115,000. Jake's final numbers. Property value, $550,000. Remaining mortgage, $115,000. Total equity, $435,000. Total cash flow, estimate over 20 years, a reasonable estimate is around $50,000. Total net worth from this investment, $485,000. He's knocking on the door of $500,000. But it came at the cost of being a part-time property manager for 2 decades, dealing with tenants, market scares, and 4-figure surprises. Now for Sim. He never stopped his automatic $300 monthly deposit. He didn't panic and sell during the big market crashes, and he didn't get greedy during the highs. He just kept going. Sim's final numbers. Total money in, $50,000 initial, plus $72,000 contributions equals $122,000. Portfolio value, approximately $510,000. The numbers are shockingly close. Sim is actually ahead by $25,000. Think about what that means. Sim achieved a $500,000 portfolio by signing some papers 20 years ago and then essentially forgetting about it. He sacrificed 0 weekends. He took on 0 debt. He never got a 2 a.m. call about a burst pipe. And here's the kicker. What if Sim had just managed to invest $500 a month instead of $300? That small change, an extra $200 a month, would have ballooned his final portfolio to over $650,000, leaving Jake in the dust. The scalability of stocks is almost effortless. For Jake to scale, he'd have to buy another house and literally double his workload. Now, this isn't a video to bash real estate. Jake's path has powerful advantages we can't ignore. The principal he paid down on his mortgage was a kind of forced savings account. He got major tax breaks from depreciation every single year. And having a fixed-rate mortgage while rents and the property value rose with inflation is a massive, often overlooked benefit. And stocks aren't a guaranteed win. Watching your life savings drop 35% during a recession is a gut-wrenching ride that makes many people panic and sell at the absolute worst time. The real trap isn't picking the wrong investment. The trap is only believing the highlight reel. It's hearing about real estate fortunes without hearing about the midnight repair bills. It's seeing the stock market's big returns without understanding the emotional strength it takes to not sell when the sky is falling. So after 20 years, who's the winner? Financially, it was basically a tie with a slight edge to Sim. But when you factor in lifestyle, time, and stress, Sim won by a landslide. He built $500,000 of wealth on autopilot. Jake built $500,000 by running a small business for 2 decades. There is no single right answer, but there is a right answer for you. Are you a Jake, willing to trade your time and energy for the power of leverage and a tangible asset? Or are you a Sim, willing to trade control for the peace of mind of simplicity and passive growth? The most important thing is to be honest about what kind of life you want to live and run the numbers for your own situation. That's the only answer that truly matters.